first issue. You're going to hear a lot of discussion, both from me and from a lot of other people, about what to do to avoid all the tax issues that are coming forward. One of the things I want to make sure people understand is you should not be doing a tax thing unless it also makes economic sense. So the comment is, don't let the tax tail wag the economic dog. And, that's going to be very, very important, especially as we talk about a few of the things as we go along. So if you have any questions with that regard, give me a call. And any time when you're looking at some kind of tax thing, if you don't understand why it makes economic sense, if it doesn't make economic sense, or you don't understand all the tax consequences, feel free to give me a call. I'm here in the office all the time. And at the end, we'll talk about all of my contact information so you'll be able to reach me no matter where we are. All right. Those of you that don't know me, or if you do know me, one of my rules is that during the course of this, I will not make I will try very hard not to make any kind of political comments. You can make any political comments you want, but basically my position is that it is not appropriate for the moderator, the speaker, to voice their political opinions. All right. It is the holiday season. It is the time of the year when people give business gifts to one another. Now, one of the things that people fail to recognize is that there is a limit as to the amount of a business gift that you can give someone and take a deduction for. And that amount has not changed in the 40 years that I have been a practicing CPA. And that amount is $25. So if you give somebody a gift card, if you give somebody, and I'm looking at a Dunkin' Donuts gift card that somebody gave me, if you give somebody a gift card for more than $25, that amount is not deductible by you unless you then turn around and make it taxable income to them. I understand the $25 is a joke in today's world, but those are the rules. 1099s. 1099s are very, very important, and the reason is that starting last year, the IRS included in all of the business tax forms 2 boxes. Box number 1 was, are you required to issue all of the 1099s? And question number 2 was, did you issue all the ones that you were required to do? And obviously you want the answers to those to be yes. So who has to get a 1099? Any non-incorporated business that you paid more than $600 during the course of the year, you must give them a 1099 for. The penalties are significant. They are very, very substantial. Why is the IRS coming down so hard? I want you to look at all of the zeros in that third bullet. The IRS estimates that the Treasury loses approximately $450 billion a year because of unreported income. That's not the unreported income amount. That's the tax amount that it is estimated that Treasury loses. They're going to come down very, very hard. They're looking very, very closely, and they are going to penalize people severely if you do not issue all of the 1099s that are required. Following on the heels of that, starting in 2011, the IRS started a new program. And what they're doing is they're going out and they are absolutely going after worker classification. What does worker classification mean? That means they're going out and looking at a worker and saying, is this worker an independent contractor, or should this worker be classified as an employee? If they're an employee, you are required to do withholdings on them. That also means that because they're an employee, it severely limits the amount of expenses that they can charge as if they were an independent contractor. They have hired over 300 new agents who will do nothing starting in 2013 but go out and audit businesses just for worker classification. So it's very important that you understand what these things are. Basically, there is no bright line test as to how a worker should be classified. There's a 20-question test which goes back, way back, as to who is an employee and who is an independent contractor. If you have questions about this, it really comes down to a question of control. Who controls the worker? Who tells them when to come and go? Who tells them how to do their job, when to do their job? Do they provide their own tools, et cetera, et cetera? All of that comes into play as to whether or not someone is a worker, that worker is an independent employee, or whether they're an independent contractor. Penalties are severe. Now, let's talk about some of the new tax laws before we get into some of the other areas. First thing we're going to talk about is PPACA, which you all know as Obamacare. What we have to take into consideration here is that this law made major tax law changes effective in 2013 that are going to affect many business people. This is before we talk about the financial cliff, before we talk about what may be coming down, before we talk about Bush tax cuts going away. What we're talking about right now is things that are already on the books that are going to take place starting in 14 days. It's a lot we don't know. One of the things that happened here, you may remember, is that Obamacare was challenged legally and was hung up in the courts for over a year and a half, and we didn't get final rulings from the Supreme Court until last June. What the IRS and the Department of Labor did, and to some degree we have to applaud that they did it, is they didn't want to waste their resources making regulations if it was going to turn out that Obamacare was going to be made unconstitutional. So what they did is they did nothing for a year and a half. And now they're working very hard to play catch-up, which leaves us with a lot of questions as to how to do things. So a lot of what we're going to talk about is the common interpretation, or my interpretation, of how these things work, or based upon the limited amount of information that we have. One of the things that we do know, and these numbers may look familiar to you, is that there is a definition of high-income individuals. And basically, for Obamacare, a high-income individual is any single person with an adjusted gross income of $200,000 or married filing joint adjusted gross income of $250,000. Now, you may notice that basically one of the things that this does is this actually creates a marriage penalty. So that, for example, if you have two people, husband and wife, each of whom earn $150,000, if they filed singly, and they're married, they cannot file singly. If they filed singly, they would not be considered high-income individuals. But because they are married and the total is $300,000 of adjusted gross income, they are considered high-income individuals, and that's what we call a marriage penalty. They're going to have to pay more taxes simply because they are married. Now, for those of you that don't know, adjusted gross income is pretty easy to find. Take page 1 of your tax return, look at the lower right-hand corner, and that is your adjusted gross income. That's before your itemized deductions, before your exemptions, before any credits or anything else. That is the number that you have to look at to see whether or not you're a high-income individual. Okay. Now, the first of the new penalties, first of the new surtaxes, is an earned income tax of 0.9%. Now, as we look at this and as we talk about the amount that's going to be earned, that's going to be taxed here, this is almost $87 billion over 10 years that it is anticipated this new tax, only this new tax on earned income, is going to result in. Now, those of you that are S corporations, all right, it is very important that you understand something. As an S corporation shareholder employee, you receive income in two ways. First, you receive income as wages. So you get a W-2, and that W-2 has withholdings in it and has payroll taxes on it. The second way you earn income is you earn income from your K-1, and that K-1 has no payroll taxes on it, and is not considered self-employment income or any other type of income that is subject to FICA and health and hospitalization insurance. That is still true. Your wages, if they're in excess of the amount, is considered to be earned income, and you will have an additional 0.9% on it if you exceed $200,000 as an individual, or your combined wages for you and your spouse are $250,000 or more. The amount in addition to that amount, the amount in excess of that high income amount, will be subject to 0.9%. Now, there's something you have to understand about S corporations. The tax law is very clear that in an S corporation, the shareholder employee must receive reasonable wages for their services. Now, prior to 2011, what we saw is that an S corporation wage, as long as there was anything there, as long as it was not zero, the IRS really did not go after the people for reasonable compensation. Starting in 2011, the IRS went after, on a test basis, one taxpayer. Now, I don't want to admit it because it doesn't look good for my profession, but they actually went after a CPA. And what that CPA did is that CPA wound up taking just over $20,000 in wages and several $100,000 in a K-1 distribution. And the IRS came in and said that amount is unreasonable. All right? And basically they went through appeals and they went to tax court and so on and so on. Excuse me. And the Supreme Court just eventually said, no, I don't want to touch this. It's not worth our discussion. And therefore, the CPA in this case absolutely lost. All right. Why is this important? This is important because what it established for one of the first times is that an amount of wages of an S corporation that is greater than zero can be considered unreasonable. So how do we determine if an amount of wages is reasonable? There is no checklist that is available. There is nothing that is available. It is just like beauty. Just as beauty is in the eye of the beholder, so is the reasonable amount of wages. Very often somebody with a lot of experience that's been around for a long time and has seen a lot of things can look at something and say, yes, I understand this amount. I understand that it is reasonable or unreasonable. What you have to remember in this case is the person that is going to be looking at this is the IRS, and they have the advantage of 20/20 hindsight. So every year you have to determine whether or not it's reasonable. One of the things that I suggest you do is that every year you have a stockholders meeting or a board of directors meeting. And you sit there, and very often all the shareholders or all the board of directors are just family members. And you sit there and you have a meeting and you say, we determine that the amount of compensation that is reasonable for this shareholder employee is X amount. And you record that just like you would in a minute book, and you keep it on file so that basically you have a detailed record of how much the shareholders or board of directors consider to be reasonable compensation for that shareholder employee. Now, with regard to partnerships, there are a few things that we have to take into consideration. First is, and we've seen several instances where this is treated wrong. By definition, however one spouse is treated, the other spouse is treated. So this is important, and we're going to talk about this a lot more when we talk about the new 3.8% tax. But if one spouse is treated as actively participated, the other spouse is automatically treated as actively participated. Second thing I want to make sure everyone understands, one of the things that we have been told is that the IRS is no longer going to rely exclusively on how the partner or member, in the case of an LLC, defines their classification as active or passive or any other way. They're going to actually go back and look at how they are being treated on the 1065, on the partnership return. If you take a look at a partnership return and you look, there's a chart on the top of page 5 that talks about who is active and who is passive in that partnership as far as corporations, trusts, individuals, and so on. And they're going to go in and they're going to ask the partnership, okay, who makes up each of those categories? And then they're going to go and look at the individual, all right, and see whether or not they complied with the way that the partnership classified them. And if they did not, they're going to say, well, why should we believe you as opposed to the business entity that actually knows what you did? Show me your contemporaneously done calendar that shows how many hours and so forth you put in to determine what your classifications are. So this is really important and something that you have to pay a lot of attention to. For the last 12 years, we have been doing something called bifurcation. And what bifurcation does is bifurcation takes in a partnership, in an LLC, taxed as a partnership, and it says, okay, in an LLC, taxed as a partnership, you don't have partners, you have members. And you have managing members and you have non-managing members. And basically the way the IRS looks at things and the way we concur it should be done is that a managing member, a member who has the ability to make contracts, make decisions for the LLC taxed as a partnership, they should be treated as a general partner. The non-managing members who really have no say in the day-to-day operations of the partnership are treated as limited partners. And what's important here is that as a limited partner, that person, for their share of the profits as a limited partner, is not subject to self-employment tax. So what we've been doing in an LLC tax as a partnership, we've been taking those LLCs, we'll make the managing member a 1% managing member, pay them a guaranteed payment based upon the amount of services they provide, and we actually have written right in the operating agreement that the amount of guaranteed payment will be determined annually by a vote of the members, which we actually make sure is done. And so their 1% plus their guaranteed payment is subject to self-employment tax, will be subject to the 0.9% if it exceeds the $200,000 or $250,000. That portion which goes to the non-managing member in their interest is not going to be subject to self-employment tax. And in doing this, we can basically sit there and actually minimize the amount of self-employment tax or the new 0.9% tax that we have. And this is something that we have defended numerous times for the IRS and won in every situation without any difficulty whatsoever. Like I said, the guarantee payments are very, very important. We believe the annual amount of the guarantee payments should be documented in some type of minutes and based upon some type of vote, preferably of all the members of the LLC. I don't know if there's anybody out there that has significant real estate investments, but one of the interesting things with regard to real estate, and this is important not only for the 0.9%, but also later as we talk about the 3.8% tax on passive income, a real estate professional, and I'm not going to get deeply into what constitutes a real estate professional, but people that spend almost all their time or significantly amounts of time dealing in real estate can, based upon certain elections, be treated as a real estate professional. And as a real estate professional, they're not automatically treated as passive and then automatically going to have a 3.8% tax. There are some downsides to that, as there are in many things where you have positives and negatives. And the downside in this situation is that because they are a real estate professional, their real estate is treated as a trade or business, which means that they could be subject to having ordinary income on the sales of their real estate as opposed to it being treated as a capital gain. So you really have to take a look and see what makes sense for you as an individual if you have significant real estate operations. Now, this is the one that's drawing all the attention, and this is called net investment income, NII. And basically what this says is that you will have a 3.8% tax on the lesser of the investment income or the amount in excess of high income. So, for example, let's assume that you have $30,000 of ExxonMobil dividends, right, and your AGI's $270,000 married filing joint. In that situation, the $270,000 is $20,000 more than the $250,000. Therefore, the excess amount is $20,000 that will be subject to the 3.8% tax. If, on the other hand, your adjusted gross income was $290,000, then you would be taxed on the full $30,000 of dividends because that was less than the $40,000 in excess of the amount. Now, you may notice here that the amount of taxes anticipated to be collected is over $123,000 over 10 years. So this is a very, very significant amount of tax that we are talking about here, and something that's going to be kind of hard to get around. So let's talk about what makes up net investment income. All right. So net investment income is all of your interest other than municipal bond interest, dividends, rents, royalties, and annuities. All right. Right off the bat, all of those things, or substantially all of those things, is going to be included as investment income. And if you exceed your minimum amount, and I hope you do, I hope you are successful, if that is the case, you're going to have an additional 3.8% tax on it. Now, for example, let's assume that the Bush tax cut on dividends goes away, which means that dividends will be taxed as ordinary income. So if they're taxed at ordinary income, in addition to whatever that ordinary income amount tax rate is, you're going to have an additional 3.8% tax on it. That means you could actually wind up, if we wind up with a 39.6% tax rate, you could actually wind up with a dividend rate of 43.4% tax on dividends, which is really incredible. All right. Now, active-passive starts off, and the important thing to remember here is that let's suppose you have a partnership or an S corporation. If you are active in that, the K-1 income that you receive is not subject to the 3.8% tax. If you are passive, then the K-1 income that you receive is subject to the 3% tax. Now, the determination of active-passive material participation is extremely complicated, but basically, to start with, think of it this way. The two most common tests are, do you provide substantially all of the activity in that enterprise, in that activity, or do you spend more than 500 hours in that activity? If either of those is true, plus 5 other tests, which I'm not going to get into, if that's the case, then you consider it active and not subject to the 3.8% tax on that activity. If you do not do that, then you're going to be subject to an additional 3.8% on the income that you receive on that K-1. So it's going to be very, very important that you determine whether or not you actively participate in an activity. Now, we are strongly suggesting that you not wait until 2013 to make this determination, that you start looking, starting with your 2012 tax return, you take a look at whether or not you're active or passive and make sure that that is properly documented on your 2012 return. Now, although it, again, is fairly complicated, one of the things you'll be able to do on a one-time basis in 2013 is you'll be able to take a look at all of the activities, if you have multiple activities that we're talking about, and you'll be able to regroup them in order to make sure that you properly are in a situation where you are achieving what you want for active and passive. Once again, that's something that's very, very complicated, but it's very, very complicated, but you have to sit down and talk about. All right. With regard to gain on sale, one of the things that you have to again talk about with regard to gain on sale is that we're sitting here and we're talking about whether or not you have a gain on the sale of property other than property held in a trade or business that is not passive. So, for example, if you are sitting there and you sell your business that is involved in an activity, you will be able to determine that because you are active in that activity, in your S-Corp, in your partnership, and you sell property out of it, you will not be subject to the 3.8% additional tax on the 3.8%. As long as you are not passive. Once again, the definition of passive comes into play here, and it is very, very important that you make sure that you do that properly. Now, I didn't write this comes right out of the definition on the Joint Committee on Taxation. One second. I'm doing a webinar. I'll call you later. I'm in the middle of a webinar. Hi. So this comes right out of the definitions on the Joint Committee on Taxation. And it says, in the case of a disposition of a partnership interest or stock in an S corporation, gain or loss is taken into account only to the extent gain or loss would be taken into account by the partner or shareholder if the entity had sold all of its property for fair market value immediately before disposition. So what we're interpreting this to mean, basically, is that when you sell your interest in a partnership or in an S corporation, basically, as long as that amount doesn't exceed the underlying value of the assets, and I can't imagine how that would be the case, if that is the case, then the 3.8% is not going to apply to what you do. All right. Now, you've probably heard a lot of discussion regarding capital gain harvesting. In most years, we talk about capital loss harvesting, making sure that you take as much of your capital losses in order to offset your capital gains. This year, people are talking about capital gain harvesting. And what they're talking about is going through and being able to take all of your capital gains this year when the federal capital gains rate is 15%, instead of waiting until next year when that capital gains rate might be basically 20% plus the 3.8% or 23.8%, which means that you have an increase of about 58% on your capital gains rates. So that's what they're saying when they're saying you should be harvesting your capital gains this year in order to minimize the amount of capital gain tax. Now, one of the things that a lot of people misunderstand is that when you sell your securities for a gain, there is no such thing as a wash sale. You can go and you can take and sell your securities, take the gain, and immediately buy them back. There is no 30-day waiting period like there would be on capital losses. So this is something that a lot of people are talking about. It is something that I strongly advise you sit down with a qualified financial advisor or your tax advisor who truly does understand all of the things that are involved in your financial picture in order to determine whether or not capital gain harvesting is appropriate for you and avoiding any possible increases in future capital gains rates. Now, there's a trap here, and actually I was just talking about this with one of the tax managers here. And the trap is that a lot of people are suggesting that if you have an installment sale, if you sell, for example, a piece of real estate or your S corporation or partnership or whatever, and you get some of the money now and are going to get some of the money in the future, that basically what you do is that you can have the option of being an installment sale, which means you're only taxed on the amount of cash that you receive. This is the trap. The trap is if you do not collect all of that income, then what's going to happen is that if you don't get a payment in the future, that's going to be treated as a capital loss. The problem with capital losses is capital losses can only be used to offset capital gains or can be used for $3,000 a year. And if you're talking about a significant amount, obviously $3,000 a year really doesn't accomplish much. So before you sit there and just take your installment sale and elect out of installment sale in order to avoid the increase in capital gains, you have to understand what we're talking about here and whether or not there is a risk that you will not collect the amount of money in the future. One of the other things that people are talking about doing is they're talking about converting their IRAs from a traditional IRA to a Roth IRA. And they're saying that you should do this because basically in the future, if you have a regular IRA, you're going to have to do something called taking required minimum distributions, which is going to add to your adjusted gross income, which makes it more likely that you're going to wind up having to pay the 3.8% on your investment income. So what they're saying is you should convert from a traditional IRA to a Roth IRA this year in order to do that because Roth IRAs have no required minimum distributions. That's all very true. One of the cautions that I have for people is that Roth IRAs are most effective when, in the future, someone is going to say, all right, I am going to have a higher tax rate in the future than I have now. And therefore, I'm going to go and I'm going to take and treat my capital gains as being this year instead of in the future. That is something you have to look at. That's why the most effective Roth IRA is actually for kids that wind up and have no real taxable income, have no taxes. So what they have is they have a zero income tax rate, and therefore because they have a zero income tax rate now, regardless what income tax rate they're going to have in the future, it's going to be higher, which is why we strongly recommend that people go and pay their capital gain, pay their kids $5,000 so that they can go and basically wind up with a zero-cost Roth IRA at this time. Okay. Anybody that has more than 250 W-2s is going to be required with the W-2s they issue in January. They're going to be required to issue on Box 12 the amount of employer-provided health insurance. Now, what is interesting here is that this is not just the amount that the employer paid for, it is the entire cost of the health insurance. Now, as you can see here, and down the bottom is an explanation of where you can find this. This is actually a chart that was prepared by Commerce Clearinghouse, CCH. They did an outstanding job, and we put a copy of it on our website, and you can see the website down below where you can get it. And what's important here is basically on the left-hand column, they've issued all the different types of health insurance coverage that are available, and then three columns. One column that says this must be included. Second column says you don't have to include this. And the third column that says you can either include it or not include it based upon whatever you want to do. And you know, we were really tempted to put our name on it, but they did a really outstanding job here. And it, once again, is on our website there. If you can't find it on our website, just give me a call, and we'll let you know where it is. All right. I am 65 years old. I'm proud to be 65. So this doesn't apply to me. All right? But however, starting next year, for those of you who have not reached 65 years of age, right, and unfortunately you have significant medical expenses, and let me tell you that my wife is a 2-time breast cancer survivor, and we finished our latest bout of breast cancer this February, and I got to see the bill from the hospital and doctors, and let me tell you, it is indeed astronomical. And if we had to pay it, I don't know how we would. But what is important here is that the amount of medical deduction threshold is raised for anybody not 65 or older, is raised from 7.5% to 10%. And just remember, the reason this was done is to pay for Obamacare. All right? This is just one, all of these things are to help pay for the cost of everyone's health insurance. Now, starting in 2018, and I kind of like this, and this is why I always include it. Like I said, I'm 65 years old, so I'm kind of old. And I remember when the best car, the car that everyone wanted to have, was a Cadillac. And I find this kind of funny because they refer to this as Cadillac plans. So basically, starting in 2018, anybody that has a Cadillac plan, which is basically defined today as a health insurance plan that would cost for a family of about $28,000, the health insurance company will have a 40% tax on that plan. Now, what I find humorous about this is the fact that we as business people fully understand what's going to happen here. If there's a tax on the plan that the insurance company has to pay, you know that that's just going to be passed on to the company that is providing that plan. So that basically, starting in 2018, these plans are just going to become even more expensive. Now, I don't want to sound anti-union, but one of the reasons that this was postponed to 2018 is that a lot of union health insurance plans that they have negotiated tend to be very, very good health insurance plans, very, very costly health insurance plans, and therefore, because of that, the unions wanted to make sure that they had time to properly assess all this so that the effective date on the 40% tax was postponed until 2018. All right. Now, one of the really great benefits that people can have is something called a flexible spending arrangement, FSA. And basically what the Obamacare did is they said this is too good a benefit for people, and therefore instead of having a large amount that people could put into their FSAs, starting in 2013, the FSA has a new limit of $2,500, which is, basically the amount that people can put away under that scenario. Now, this is one I've never understood, but I like it just because it demonstrates the amount of money that's involved here. PPACA established a new type of entity, and that entity is called the Patient-Centered Outcomes Research Institute, and there is a fee attached to it. And basically that fee is $2 per average covered life. You notice that I did not say that it is $2 per average covered employee. It is average covered life. So basically, for a family of 4, it would not be $1. It would not be $2 just to cover the employee. It would be $8 to cover the employee and the employee's 3 dependents. So basically, what we're sitting here saying is that all this money is going to go into this Patient-Centered Outcomes Research Institute, $2 per average covered life, and this is currently effective. It is effective for years ending after 9/30/12, and don't ask me how they came up with that date because I have no idea. All right? But once again, think about this. Basically what this says is that if you're sitting here and you have 50 employees and each employee is married with 2 kids, all of a sudden you're talking about 200 lives, $400. You know that $400, even though it's a relatively small amount, is coming right back to you as a additional fee from the insurance companies. I want to talk a little bit about the employer mandate, which is called pay or play. This all starts in 2014. What is important here is, and the reason I want to make sure we talk about it, is that there is a look-back period. Right? And basically that look-back period, depending upon your business, can be very, very important because it can define especially what's called variable hour employees, which are employees that work different numbers of hours in different times of the year and different times of the month, depending upon what they do. So that in order to determine whether or not somebody is a full-time employee, you can establish this look-back period, and that look-back period can be anything from 3 months to an entire year. So that means that if you want to do this, you have to start looking, starting in 2013, you have to start looking at who is going to be considered a full-time employee and who is not, and we'll talk about who is a full-time employee in a few minutes. All right? So basically, any business that has 50 or more full-time equivalents is going to be treated as having to provide health insurance for their employees. And one of the first questions that everyone asks me is, if you have related parties, if you own more than one business, do you have to take all the employees from all your businesses into account? And the answer is yes. The 50 related parties count towards the 50 employee threshold. All right. Now, one of the things that the Obamacare did is it did away with what's called a mini-med plan. And a mini-med plan is kind of like an upside-down health insurance plan. What a mini-med plan says is, for example, that the insurance company will cover the first $2 or $3 or $4 or $5,000 of health insurance costs, but after that it's all on the employee. And that's called a mini-med plan. And basically those are not allowed under the new plan starting in 2014. Now, the shared responsibility, which is how we talk about the employer mandate, has a couple of new situations. The first is something that is called minimum essential coverage. And minimum essential coverage, we'll talk about in a couple minutes, is the amount of coverage that you, the employer, must provide to employees. The second thing that you have to remember is that an employee can pay no more than 9.5% of their family income in order to have their single coverage. Now, if you're wondering how you're going to find out about an employee's family income, I will tell you after talking to various attorneys that you cannot go up and ask your employee how much they make in their other job, how much their spouse or anybody else makes. So basically you have no way of finding out what their family income is. So what the IRS has said is that instead of using the family income, you can use the individual's W-2. So think about what this says. What this says is that instead of 9.5% of family income, all you really are sitting there is you have 9.5% of that person's W-2. So that basically what it means is they have to contribute less, and you, the business owner, have to contribute more to their health insurance. Now, if you are a full-time employee, and a full-time employee is defined as someone that works 30 hours a week on average. That person, if you choose not to have coverage for them, you pay $2,000 per full-time employee that is not covered, and that's charged quarterly. Now, the good part about this is that in calculating how much you owe, the first 30 employees that you have are free. So, for example, if you have 29 employees, full-time employees, you will have no penalty that you will have to pay. You will have to make no contributions for this. Likewise, and this is something that we've seen a lot of discussion about, if you have all part-time employees, if all of your employees work 29 hours a week, then once again, none of them are considered full-time employees, and you have to provide any health insurance for them. So this is, again, very, very important in determining the calculation. Now, the other thing that is really unfortunate here is if you have to pay that $2,000 penalty, that is a penalty. It is not a tax, and as such, you don't have to worry about it. I have a comment here. If you have 29 employees, you fall under the 50-employee threshold. That's absolutely correct. If you have 29 employees, whether they are full-time or part-time, you couldn't reach the 50 full-time employees. So that basically, as long as you have less than 50 full-time equivalents, or you have less than 30 full-time employees, you're not going to have anything that you have to worry about. That's absolutely correct. Now, I clicked too hard. Now, this is where we get to what the definition of health insurance coverage is. All right. If an employer fails, I didn't write this. If an employer fails to offer insurance that equals at least 60% of the covered expenses, or the employee has to pay more than 9.5%, which we discussed, of income, and at least one employee gets a premium credit in an exchange because they're not covered, they went to the state exchange or the federal exchange, and because they make less than the required amount, they get a credit because they have to pay less. If that's the case, then the amount that you have to pay increases for that employee or employees from $2,000 to $3,000. Now, I really don't care about that because what is interesting about this penalty is that $3,000 penalty, regardless how many employees it is, cannot exceed the amount that the $2,000 penalty would be. You know, so that it's kind of interesting the way that math works. Now, I want to jump back here. All right. When we look at this, one of the things that is really important to look at is that it talks about the insurance is equals to 60% of the covered expenses. Now, what that means is that the minimum essential coverage that is required for an employer to provide an employee has to cover the actuarially computed value of 60% of the covered expenses of all the employees. Which, when you think about it, is really means that if you had a situation like I had with my lovely wife, Tina, you could have a really serious amount of money since it's only covering 60% of the cost of the medical costs here. So that I think this is one of the limitations of PCACA that only 60%, that it only has to cover 60% of the cost of medical insurance. And I think that's kind of low. And I know here in Massachusetts, for example, in Hawaii, for example, the two that I'm most familiar with that already have businesses that have to cover insurance, the amount of insurance that is covered is significantly more than 60% in both of those states, and in Vermont, which is another one that has this required coverage. All right. Now, on our website, once again, we have developed an exposure estimator so that if you will have more than 50 full-time equivalents or more than 30 employees, basically you can fill in this estimator and it will determine what we think the maximum exposure would be and where you fall in the 9.5% of coverage for your employees are. And again, that's on our website, and if you have problems finding it, give me a call and I'll help you find it. It's really, really important that you understand how much this exposure could be for you. I very quickly want to talk about something that we've talked about a great deal, and that's the new repair rules. The IRS recently came down and said that instead of the new repair rules taking effect in 2013, starting in 2012, they're going to take effect starting in 2014. What is important here is that in some situations, especially for people that have significant real estate holdings, it may be beneficial for people to consider early adoption of certain parts of the new repair rules. Now, it is possible those rules are going to change in the future, but for now, people, especially people that have significant real estate, should be sitting down and discussing with their accountant or somebody else that is really familiar with the new repair rules whether or not it makes sense to follow these new rules and consider early adoption. Basically, it's not going to be very effective for other operating businesses because in most situations it's going to require more capitalization of repairs. What the advantage with real estate is that it is going to significantly make dispositions of certain segments of buildings be able to take more expense on that than you currently have, and that's something that, especially if you have a real estate environment, you should be talking to somebody that understands how these new rules work. Are you a gambler? I want to talk about gifting. We only have a couple of weeks left. I want to emphasize we have no clue, absolutely no clue what is going to happen. What is going to happen in the future, starting in 2013, with gift and estate? We're going to talk about some of the options in a minute, but because we have no clue, we think it's important that people of means sit down with their accountant, sit down with their financial planner, and figure out whether or not gifting should be available to them. Now, in doing this, I want to emphasize my rule number one. Rule number one is that it is important for people to understand that they should not be giving away so much to their children or others that it could significantly impact their standard of living in the future. That's very, very important. Unfortunately, we have seen situations where parents have given away substantially all of their assets to their children and then needed some of those assets back, and they can't get them back for the children either because the children spent them or the children refuses to give the money back to them. So that's why I have rule number one there, is make sure that you take care of yourself and your spouse first. Other thing I want to make sure that you're aware of is on our website we have something that's called the Personal Estate Inventory, which is a fairly extensive Excel spreadsheet that allows you to put all of your different assets, all of your liabilities, all of your life insurance, all of your passwords, all of your information, so that when you sit down with a financial planner or your tax accountant or whomever in order to determine what you have and what you should be doing, all of that information is in one place on the Excel spreadsheet. The other reason to do this, and this applies to me and the wonderful Tina, is that basically in our situation, I know where basically everything is, and Tina really doesn't. She kind of relies on me for that. But if something should happen to me, it is very important that she was able to go to one place and find out, for example, what our user ID and our password is to our Fidelity account. And all that information is right there, so that if something happens to me, she can access all of our assets and do whatever she has to do without me, so that if something happened, she has no financial difficulties. The reason we're talking about gifting is that this year, the lifetime exemption, the amount that you can give away during your lifetime, is the highest it has ever been at $5,120,000. If you exceed that, the maximum tax rate is 35%, which is the lowest it's ever been. We have no idea what is going to happen in the future. What we do know is that if Congress and the President do nothing, that lifetime exemption is going to drop to $1 million indexed for inflation, which is about $1.3 million. So that instead of being able to give away $5,120,000, you'd only be able to give away $1.3 million, and the maximum tax rate in excess of that is going to be 55%. Again, we don't know what's going to happen. What the President proposed a year ago is that the estate tax exclusion would be $3.5 million. He said at that time that the gift tax exclusion would be $1 million, and he didn't say anything about whether or not there would be portability, which means, for example, that if I don't use my lifetime exemption, my wife gets to use it if I should die, which is what portability is all about. We don't know where that's going. We don't know which is going to happen here. Obviously, as we talk about a little bit about the financial cliff, this all comes into play. You'll notice that nothing has really been said about this. This is a relatively minor thing as far as Congress and the President is concerned. So we just don't know what's going to happen here, and we may not know for several weeks, which is why we are saying if you have significant means, you should be definitely sitting and talking to your financial planner, talking to your estate tax attorney, talking to your qualified tax accountant as to what you should be doing if you have a significant estate. The other thing that we want to talk about is one of the things that is at risk is the ability to take discounts on gifts. So, for example, let's suppose that you own a very successful business that's worth $30 million, and you want to give 40% of it to your son or daughter. What we would be able to do is, because that's 40% is a minority interest, it is less than 50%, and they lack control because we would make sure that they don't control your business. You control your business. Instead of having a $12 million gift, we'd be able to take a discount of approximately 40% on that gift. So instead of having a gift of $12 million, we'd actually have a gift of about $7.2 million, which means that we can significantly reduce the amount of the gift. We don't know what's going to happen with discounts. They may go away. They may not go away. We just don't know. So once again, this is something that we want to talk about and make sure we're addressing. Now, one of my favorite ways of making a gift, and I always talk about this because I enjoy it, is something that is called an intentionally defective grantor trust. And I don't want you to remember intentionally defective grantor trust. It's kind of cumbersome. I want you to remember the term gold mine trust. And the reason I call these a gold mine trust is that basically what it does is it allows mom and dad to make a gift or sell assets into this intentionally defective grantor trust. The income from that trust is going to go to their beneficiaries, their son and daughter. However, the tax on that income is still going to be paid by mom and dad. So what happens here is the kids get the gold and mom and dad get the shaft. They have to pay the tax. So why would you do this? Remember what we're trying to accomplish. What we're trying to do here is we want to make sure that what we've done is taken as much assets out of the estate as we possibly can for as little cost as we can. Now, what is interesting in this situation is that tax which the parents pay for the kid's income is not considered a gift or in any way affects the gift and estate of the parents. So it's really an additional tax-free gift and therefore a very, very powerful estate tax planning tool that can be used. Generation skipping tax, all right, or dynasty trusts. What a dynasty trust basically does, which comes into estate, is basically it allows you to set up a trust and have the assets of that trust pass from generation to generation to generation. So, for example, when you take the Kennedys, for example, or the Rockefellers, for example, what you see is that these families set up dynasty trusts years ago, and you see that generation after generation is able to, with the permission of the trustee, access all of those funds going forward year after year after year, generation after generation after generation, with no additional tax other than what was first set up. So that basically what we're sitting here saying is, if you have very substantial assets, you should be sitting here and you should be talking about not only what you want to do to your next generation, to your son and daughter, but also to your grandchildren, great-grandchildren, and so on, in order to take care of multiple generations, and that's done by something that's called a dynasty trust, and that is something that, if you have substantial assets, it is absolutely something that we strongly advise that you set up. Now, there's another situation that I want to make everyone aware of, and and that is something that is called a new concept, and basically it's based upon a tax court case called Wandry. And what Wandry said is that you can do, and you can make a gift, and let's go back to your gifting 40% of your closely held business. What we would do in that situation is we would not say that we're gifting 40% of the closely held business. We would say that you're giving $12 million of value there. So basically, instead of having a certain amount of ownership, 40%, we're saying that no, you don't have 40%, you have $12 million. So what that means is if the IRS comes in and they say, no, we question the valuation of this, we don't think that the value of the gift is $12 million, we think the value of the gift of the 40% is not $12 million, we think the value of the gift is $15 million, you owe tax on $15 million. We say, no, you have to read the document. The document says the value of the gift is limited to $12 million, therefore we owe no additional tax. All that happens is we just gave them a little less percentage. So that basically this is a new concept called formula gifting. And what is interesting here is that a few weeks ago, the IRS came along and said, wait a minute, we had previously appealed this case, because we didn't agree with it, and therefore we're going to appeal it to a higher court. A few weeks ago, the IRS said, no, we don't want to appeal this to a higher court. So everybody got all excited and said, we won, except then the IRS came in and they issued what's called a notice of non-acquiescence, which means that the IRS has agreed that they will not appeal the Wandry case. However, they do not acquiesce to that case, which means they maintain the right to continue to attack these situations, hoping that they're going to find one where they think is a better court in order to try it. Now, based on that, should you move forward with Wandry? And the answer to that is absolutely. We are strongly advising people to continue to use the Wandry case. We think it is a very powerful case. I personally think that the court in that situation was absolutely right. The IRS is wrong, and regardless of where the IRS tries to attack this case, I think that they're going to lose. So that basically this is definitely something you should do. If you want a copy of that case, if you want to see exactly how the wording should be done, give me a call or email me, and I will forward that information on to you. I want to talk about something that's called reciprocal trusts. What it's actually called is a slat. And basically what happens in this situation is that we have a situation where a husband and wife take their assets and they say, wife says, I'm going to take my assets, I'm going to put it into a trust. The beneficiary of that trust is my kids and my husband. The trustee of that trust is my husband. The husband takes and puts all of his assets into a trust and says the beneficiary of that trust is my wife and my kids. All right? And the trustee is my wife. So what they've done is they've basically made a gift of their assets, all right? But at the same time, they've reserved the right because their spouse is a potential beneficiary. They can get at those assets if they should need them. Now, there are some very, very specific, very, very technical rules as to how this must be done. They should not be done at the same time, which means you don't have a great deal of time left to do these. They cannot say, the trust cannot be worded exactly the same way and other situations, but it is a very, very powerful situation. It is one that we are doing with several of our clients right now that I'm reviewing. Very, very powerful situation where someone has assets, they want to put them into a trust, they want to take advantage of the large lifetime exclusion, but they want to just make sure that they have the opportunity, if they should need it sometime in the future, to come back and actually get those assets back so that they and their spouse can use them. Expired and expiring tax provisions, you'll notice I put a website down the bottom. The Joint Committee on Taxation has issued about a 30-page report that lists all of the expired and expiring tax provisions for the next 10 years. It's kind of interesting. You know, we have to understand that when we're talking about the financial cliff, and we talk about, for example, we talk about the Bush tax cuts going away, and we talk about some of the other things, there's a tremendous number of expired and expiring tax provisions that are going to affect a whole lot of people. So, for example, one of the expired tax provisions is that a school teacher who, out of their own pocket, brings supplies into school, because a lot of our schools have difficulties in providing all the supplies that a teacher would want, is able to take a deduction on the front of the tax return of $250 because they, out of their pocket, went and spent and brought money in for the benefit of their students. That expired and isn't available this year. You know, as silly as that sounds, that hasn't been renewed, so that, you know, that's an expired tax provision. In some industries, a lot of people hire certain types of employees, disadvantaged employees, youths who are at risk, and so on. And that's called a work opportunity credit when you hire certain classes of employees. That's also gone away this year. So that basically the list goes on and on and on. I don't want to get into the whole list, but that's something that you have to take a look at. And basically that website gives you the details of all of those that have expired. Tax reform and the financial cliff. Those of you that are following the news, the Republicans just put forth a proposal to the Democrats, to the administration, that said they would consider raising the tax rates on people with income in excess of $1 million. That's a major shift in what they've done before. There are other things that are up for grabs that you have to consider. One of the things that the Republicans previously had suggested is minimizing the benefit of itemized deductions, and I talked about two ways to do that. One way to do that would be to take your itemized deductions and say that they cannot exceed a certain amount, and the amount that's been thrown around is $50,000. So that if you had itemized deductions in excess of $50,000, basically they would be lost. The other thing that they talked about doing is minimizing the percentage of benefit that an itemized deduction could have. So that, for example, instead of your itemized deductions benefiting you at your highest marginal rate, you may only benefit at 28%. All of these things are currently on the table. We basically have no idea what is going to happen, when it's going to happen, whether it will happen in the next 2 weeks before the end of the year, or whether it will happen in January or February. One of the things that is kind of interesting, and I was talking to some friends of mine who are with the IRS in Washington, and they said, you know, you people forget something. And they said, you accountants forget that we at the IRS are responsible for preparing the tax forms. So that you're sitting here talking about all of these things that can happen. We're sitting here and saying, wait a minute, we can't even prepare the forms that are going to be necessary in order to prepare the tax returns. So that you may have read that it is possible that in some situations, people may actually not be able to get their refunds because the tax forms aren't available early in the year the way they normally are. This is something we're going to keep track of. As things progress, we'll be sending out information to all of our clients and friends through our blast email system. If you're not on our blast email system, contact our office and we'll put you on it. We don't know what's going to happen. We don't know when it's going to happen. But when it does, we'll make sure that everybody receives the proper information. I want to make sure that people are aware of this. I don't know if it affects any of you, but one of the things that has happened is that the Defense of Marriage Act, which is a federal law that defines a marriage as between a man and a woman. And basically in the last two situations where this has been attacked in federal court, the court has said, no, that is discriminatory. That law cannot be upheld. It is unconstitutional. The reason I want to talk about it is that if it applies to you, if you are in a same-sex marriage or know someone that's in a same-sex marriage, what is important here is that they should be filing for a protected claim of refund, so that whenever this comes through, whenever it's decided, and the Supreme Court has indicated that they will indeed take this up, you'll be able to get refunds if it is appropriate for whatever taxes you overpaid federally because you were not able to do marriage filing jointly. I want to make everybody aware of this, and as I've been doing this for whatever, I've been telling people about this. And please understand, I am not in any way, shape, or form indicating that any bank is at risk, but I just want to make sure that you're aware of this. Basically, a non-interest-bearing transaction account, which is a long way of saying an operating account for a business, basically starting in 2011 as part of the Dodd-Frank Act, increased the amount of insurance for these business accounts for 2011 and 2012. It increased that insurance, that FDIC insurance, up to unlimited. So if a bank failed, all right, a business would not lose any money regardless of how much they had in their business account. What happens effective 1/1/13 is that amount of insurance drops down to $250,000. What I'm suggesting that people should do is just pick up the phone, call their bank. Many banks have additional insurance that they have bought in addition to FDIC, and just ask the bank, okay, do you have additional insurance? What is your insurance amount? What are your policies, et cetera, et cetera, et cetera. Very nicely just ask your banker what that situation is so that, God forbid something should happen to your bank, you would not be at risk of losing any money. If you want to learn more, you can sign up for our newsletter. We can sign up on our website, or we have a weekly newsletter that comes out. Plus, basically, we have what I call on a regular, irregular basis, whenever anything of substance happens, we go and provide all the information as quickly as we can, and we try and make sure that everybody receives that information quickly so that they can do it. And if they have other questions, they can call and ask me or someone else here as to what the situation is. That is me. That is my direct line. That is my cell phone line, which you can always reach me on. That is my Greg Land Gray email address, and I will give you my personal email address, which I also check regularly. It is very hard to remember. My personal email address is Mike, M-I-K-E, at the Koppels, TheKoppels.com. Sometimes things get hung up in our spam filter at Greg Land Gray. If you send things directly to me, you can pretty well be guaranteed it doesn't get hung up in my personal spam filter. It comes straight through to me. Does anybody have any issues or questions that they want to address? Okay, Obamacare. Of course, as a Massachusetts company, you already have Romneycare. Romneycare is significantly different, but yes. What has been your experience with that, and how has it affected businesses and their operating strategies in Massachusetts? Let me answer that a couple of ways. First thing you have to realize is that there are significant differences between Romneycare and Obamacare. So that, for example, the number of employees that you have to have in order to cover your employees in Massachusetts is much less than it is federally, which is bad. The second part is that the penalties in Massachusetts are significantly less than with Obamacare. One of the interesting situations is that right now we have 98% in Massachusetts of our people covered by health care, which is the highest in the nation. The other thing that has happened in Massachusetts is that unlike Obamacare, we didn't have to impose any taxes on the individuals in order to pay for it. That is partly because Massachusetts already had a very high percentage of employees covered. The one thing that we have seen is we have seen some very disquieting additional penalties imposed. And let me give you an example of one, and I am told by people that I trust that are employee benefit experts that this will also apply to Obamacare. We had situations where we had a client, right, and that client had a manager, and that manager hours, that was a 40-hour-a-week manager, became pregnant, and their hours dropped to 25 hours a week. Not unusual when the person became pregnant, with all of the situations that went with that. The employer was a good duty and continued to cover them on their health insurance plan. Massachusetts came in an audit and said, wait a minute, because you covered that person for 25 hours, you now set the bar at a lower level. Therefore, anybody that was covered for 25 hours had to be covered for insurance, and they wound up being penalized tens of thousands of dollars because of that. We are told that the same thing is going to apply under Obamacare, for example. That's something that is not yet written, but we are told is going to happen. What we have not seen in Massachusetts is a situation that we talked about where there's been a rash of businesses reducing the amount of time that employees have down from full-time down to 29 hours that we've heard discussed a lot. We haven't seen that. So basically, we haven't seen a lot of changes in people's coverage. In a few cases, people had to have a little bit better coverage. But aside from that, it's been pretty straightforward as to what we have going forward. So we haven't seen, from a business point of view, other than those rare occasions when they've come in and audited and found something unusual, we haven't seen a great deal of problems here in Massachusetts. We envision a lot more problems with Obamacare, especially because of the additional taxes that are going to be in place, number one, that are going to take place. So, that's what we're envisioning happening starting in 2014 with Obamacare. Are there any other questions? Okay, I want to thank all of you for attending. If you have any questions, give me a call here in the office or on my cell phone, and I wish you a happy day. Bye-bye.